Hi, this question is an income statement and a statement of financial position for a sole trader, and it's a more difficult trial balance. You can see it there. So you've been asked to prepare an income statement and a statement of financial position for 31st of December 2020. Left-hand side is debit, the right-hand side is credit. There are all the accounts, and the closing inventory at the end of the year was 2,900. So the first step in doing an income statement, now there are no other adjustments to the trial balance. The first step to doing the income statement is to identify what are the income and the expense accounts, because basically the income statement is your income less your expenses. So we've only one income account, which is sales. Sometimes there's other income like rent received. Income accounts or revenue accounts will always be on the credit side. And here we've just got one sales account. I'll just look down. What else is on the credit side? So revenue or liability accounts, and the other accounts on the credit side are payables and capital. So payables is liability, capital is equity. They go in the statement of financial position. And purchase returns reduces purchases. So the only income account is sales. So that sales will be the first line in our income statement. And if there are any sales returns, here they are here, €204, they'll reduce the sales returns figure or the sales figure. So here's our starting point, sales less sales returns. Sometimes that's called returns in. And we just get a net figure 2196. Maybe I'll just move it like that so it's more in line with the others. So your sales less sales returns gives you a net sales figure of 2196. The next stage in your income statement is what is your purchases figure, and we always adjust our purchases figure for these items. If there's any purchase returns, sometimes called returns out, it gets increased for any opening inventory, it gets reduced for any closing inventory, and any other purchase costs such as transport costs in, which is also called carriage in. So they're the things we look for in the question, and we'll find them here. I'll call them cost of sales items. So in cost of sales basically is your purchases here, which is 11,500 in the trial balance. It'll get reduced for any purchase returns, any other purchase costs such as carriage in, which are 300, and also we'll reduce our purchases for any opening inventory. So opening inventory is basically purchases of goods that were unsold at the end of last year. And then the other adjustment always that you've got to remember is your closing inventory, which is underneath the trial balance here, which was 2,900. And we just put those amounts in. That's our cost of sales figure. So all of these items here add up to 10,970, and that reduces our sales figure down to a gross profit of 9,226. The next thing is to add any other gains or income accounts. Now, there were none in this trial balance. Remember, we looked and the only income account was the sales of 20,400, and then less expenses. And the expenses are further up the trial balance here, and I'll just highlight them. Expenses are expenditure on day-to-day running items for running the business. So carriage out, delivery cost to customers, rent, insurance, wages, motor expenses, office expenses, light and heat, general expenses, all expenses. And you'll notice they're always on the debit side. So on the debit side or the left-hand side of the trial balance will be expenses or assets. So, and what's left on the debit side, if we go down there, these items are assets, bank is an asset, drawings is equity. So there are no other expense accounts. So all I do then is just transfer them into the income statement and reduce our gross profit for those expenses. So the total expenses go in here, they add up to 6,195, and our gross profit less our expenses gives us a net profit of 3,031. And that's the income statement finished. So there's the income statement, sales, gets reduced for any sales return, but sales less purchases or less sales less cost of sales gives you gross profit. Add other income and less your expenses, and you end up with a net profit of 3031. Next is the statement of financial position, which is your assets, equity accounts, and liability accounts all listed down, and the total of the assets accounts should equal the total of the equity added to the liabilities. So once again, assets are always on the left-hand side of the debit side of the trial balance. So premises, motor vehicle fixtures, long-term assets, they're in our non-current assets. Receivables, customers that owe us money, and banks on the debit side, that's current asset. Short-term asset expected to be there for the next 12 months, but not beyond the next 12 months. So it could change within the next 12 months, whereas non-current assets are expected to be held for longer than a year. And the other current asset is always closing inventory, which is always the one that's underneath the trial balance. Opening inventory was at the top. The only time that opening inventory goes into the accounts and cost of sales. So opening inventory at the start of the year never goes into your asset. It only ever goes into cost of sales and gets added to purchases. Whereas closing inventory goes in twice. It reduces purchases and it gets added into current assets. So here's the top half of the statement of financial position. Non-current assets and current assets. Group them together and the total assets are 16,250. The bottom half then is the next, where we show our equity accounts and our liability accounts. Equity is always 3 accounts. Capital at this level is always 3 accounts. When you do more difficult questions in further years of study, there'll be more than 3 accounts. But capital, share capital, drawings, which reduces equity, is always minus, and then retained profits 3031, which, if you remember, was the net profit we got in the bottom of the income statement. We got 3031, so that just gets carried down to equity. And then our liabilities there, and you'll just remember we found all them in here. Here are the 2 liability accounts, drawings and capital. And here's the only liability we have on the credit side, which is payables. So they just get shown. And you'll notice the total of the equity and liabilities agrees to the total of the assets. And that's the statement of financial position finished. So there it is again, statement of financial position, assets, which are just picked from the trial balance. And then equity and liabilities. And all the amounts are picked from the trial balance.